Hey guys, it's Harry here. Did you know that around 90% of new real estate investors fail within their first year? What's even more shocking is that most of them fail because of myths and misconceptions they believe. Today, I'm going to bust the most dangerous real estate myths out there, so you can avoid costly mistakes and actually succeed in building wealth. Let's start with myth number 1. You need a ton of money to get started. How many times have you heard this one? Most new investors think real estate investing requires massive capital or huge loans, but that's simply not true. In fact, some of the most successful investors I know started with barely anything in their pockets. So, how exactly do you invest in real estate with little to no money? Stick around, because I'll reveal the surprisingly simple technique seasoned investors use every day. Now, myth number 2 might surprise you. Real estate investing is easy passive income. Sounds amazing, right? Buy a property, sit back, and watch the money flow in. Unfortunately, the reality is a bit different. While real estate can become passive eventually, getting there requires a lot of upfront work, especially when it comes to finding great deals and managing tenants effectively. But here's the twist. There's a strategy the pros use to turn active investing into a truly passive income stream over time. Want to know how they do it? Keep watching because I'm about to share it with you. Before I get to that, let's tackle myth number 3. It's all about location. We've all heard it 1,000 times. Location, location, location. Sure, location is important, but here's what most beginners miss. A great location alone won't guarantee success if you don't understand the market dynamics. Investing in a trendy neighborhood without analyzing key metrics is like playing roulette with your money. So, what are the critical market metrics every investor must know before buying? I'll dive into that shortly, but first, let's bust myth number 4. You must have perfect credit to invest. This one stops countless would-be investors in their tracks. The truth is, while good credit certainly helps, there are plenty of alternative financing methods available for investors with less than perfect credit. Curious how investors with bad credit are still buying properties every single day? Stay tuned, because I'm about to uncover some secret financing methods that banks rarely tell you about. But first, back to how successful investors make real estate truly passive. It's all about building reliable systems and leveraging teams. Seasoned investors rarely manage properties themselves. They delegate to trusted property managers, maintenance crews, and even virtual assistants. Building a strong team from the start means your real estate investments eventually run on autopilot, generating income while you sleep. Now let's circle back to the market metrics you absolutely must understand. Aside from location, you should analyze 3 key factors: job growth, population trends, and rental vacancy rates. If jobs and population are increasing while vacancy rates remain low, you've found a market with strong demand. And strong demand equals steady cash flow and rising property values. So, about financing without perfect credit, here's the secret: creative financing. This includes options like seller financing, lease-to-own arrangements, and partnerships with other investors. Seller financing in particular lets you buy property directly from the seller, making payments to them instead of a traditional lender. This method requires minimal credit checks and can offer amazing flexibility. But wait, how do you actually convince sellers to agree to creative financing? I'll share the negotiation tactics expert investors swear by in just a moment. First, let's address myth number 5. You'll get rich overnight. Unfortunately, real estate investing isn't a get-rich-quick scheme, despite what some gurus might tell you. Yes, wealth can come quickly, but it typically requires patience, planning, and strategic execution. Setting unrealistic expectations is why many beginners quit after just a few months. Here's the truth: real estate investing is a long game. Success usually comes to those who consistently follow proven strategies, reinvest their profits, and remain patient when challenges arise. Alright, so how do seasoned investors negotiate seller financing successfully? The key lies in finding motivated sellers, people who need to sell quickly. Maybe they inherited a property, are relocating, or facing financial hardship. These sellers are often willing to consider creative solutions, especially when you highlight the benefits, such as steady income for them, quicker sales, and fewer hassles. Now, speaking of challenges, here's myth number 6. You can avoid risk completely. Many new investors are terrified of losing money, but the reality is all investments carry risk. The secret isn't avoiding risk altogether. It's learning how to manage and minimize it effectively. So, how exactly do successful investors mitigate risks and safeguard their investments? The answer is surprisingly straightforward, yet most beginners overlook it completely. And that's exactly what we'll explore next, along with some even bigger myths that could cost you thousands if you don't know the truth. Stay tuned, because understanding these could mean the difference between massive success or painful failure in your investing journey. Risk management boils down to one powerful concept: diversification. Successful investors know never to put all their eggs in one basket. Instead, they spread their investments across different types of properties, markets, and strategies. This approach significantly reduces the chance that one bad deal will ruin everything. But hold on. How do you diversify properly without spreading yourself too thin? The answer lies in mastering just a few proven strategies before expanding. Start with one type of property or one market. Become an expert, then gradually branch out. This controlled diversification is exactly how seasoned investors build resilient portfolios. Speaking of resilience, let's bust myth number 7. Timing the market perfectly is the key to success. Here's a reality check. No one can consistently predict market peaks or bottoms, not even the so-called experts. Trying to time the market usually results in missed opportunities or rushed decisions that cost money. So, if market timing doesn't work, what's the alternative? Simple: consistency and discipline. The most successful investors consistently buy good deals, regardless of market conditions, and hold on to them long term. Time in the market always beats timing the market. But wait, how do you consistently find good deals, even when prices seem high? In just a moment, I'll share the secret strategies professional investors use to uncover hidden gems. First, let's expose myth number 8. You have to handle everything yourself. Many new investors burn out fast because they're overwhelmed trying to handle every detail alone. Real estate is a team sport, and the faster you build your team, the faster you'll see results. How do you quickly build a reliable team without wasting time or money? Here's a proven tactic. Start by partnering with experienced investors or mentors who already have established networks. Leverage their relationships to find trustworthy contractors, agents, and lenders. This simple step can save you countless headaches and drastically accelerate your success. Now, back to finding hidden gem properties. Where do you even start looking? Seasoned investors rely on something called off-market deals. These are properties not listed publicly and often come at steep discounts. To find these deals, you must network actively, use direct mail marketing, or even employ creative methods like knocking on doors and speaking directly to owners. But let's address myth number 9. More properties always equal more profit. This might sound counterintuitive, but more isn't always better. Owning multiple poorly performing properties can drain your resources and quickly erase your profits. So, how do you ensure each property you buy is profitable and aligns with your goals? The answer lies in careful, disciplined analysis. Always calculate potential cash flow, return on investment, and future appreciation before making an offer. If the numbers don't make sense, walk away, no matter how tempting the deal might seem. Finally, let's bust myth number 10. Mistakes are fatal. Many beginners are paralyzed by fear of making errors, but here's the truth. Every successful investor has made plenty of mistakes along the way. The difference is they learn from these mistakes, correct course, and keep moving forward. Mistakes can actually be your greatest teachers. Embrace them as part of your learning journey, adapt quickly, and you'll become a smarter, more confident investor in the long run. Remember, success in real estate investing comes down to consistency, education, and strategic action. Avoid these common myths, stick to proven principles, and you're already ahead of 90% of other investors. So, what's your next step? Pick one myth we've busted today and take immediate action. Whether that's contacting potential partners, researching off-market deals, or setting up your first diversification plan. Every big win starts with a small, deliberate step. If you've learned something valuable today, share your insights in the comments below. Until next time, stay focused, keep learning, and I'll see you soon.